Matt, really appreciate you being here. Real estate and technology have had a complicated relationship for a long time. A lot of hype, a lot of software that never really delivered, and a lot of operators who got burned along the way. Stellifi was built to fix that, backing founders who are solving real painful operational problems and proving the return on investment before anyone else has to take the leap. Now, you've built something genuinely different here, and I would love for you to tell us a little bit about Stellify. Most venture funds talk about adding value to their portfolio. You actually own the buildings you're testing your investments in. Can you explain how that works and why it changes everything the way you back companies?
Yeah, so it's and thanks for having me. So I think, the origin story I think is a part of it, right? So there's three of us that are partners in the fund. We run two different businesses. So Paulo and Nick run a value add multifamily fund or firm. They're on Fund Five. I do ground up real estate development, mostly in institutional multifamily. And so in our real estate careers, we kept running into situations where it was obvious that there was a needed software solution. And so the way we all kind of started independently without talking to each other was, oh, well, there must be a faster way to get incentives, or there's got to be a better way to keep track of maintenance orders and procurement and turnover, right? Or whatever the issue was. And so you'd go out and you'd start looking for software, and then you'd find out that it didn't really exist, right? Or if the stuff that did exist didn't solve your problem. And so, while sort of doing that, right, and also each being active angel investors, it started to become clear that there was sort of an opportunity to think about this space a little bit differently. We knew we didn't want to be a venture studio. Not that there's anything wrong with that model, but running a real estate business and running a venture studio are pretty challenging. And so, we thought a lot about it. We have the ability to incubate some companies ourselves. We've done this once now, I think to pretty good success so far. But really, I think we obviously have some insight into multifamily asset operations, right? What have you. And then I think that the more valuable thing, though, is the perspective of the buyer, right? So, if your ideal customer profile as a founder is anybody in that commercial value chain, from identifying the asset through, construction, capitalizing, stabilizing, and running this thing, and then eventually disposing of it, there's sort of a sort of set of considerations or a mindset that goes along with that. And so, yeah, it's helpful to pilot product. One of the things that I think is most helpful is giving product-oriented feedback. That's where we've spent a lot of our time. How do you make this thing a no-brainer to use for a busy real estate operator? So I think that's, ultimately, I mean, when you have a successful company with hundreds of thousands or millions of units, right, we can't provide that. But I think it's more of that learning and that feedback. And then as a result, we're pretty involved, and as involved as anybody wants us to be in terms of, the operations of the business, or hey, this is the hard problem this quarter, let's solve it outside of the context of a normal board meeting.
Understood. So, you call it a sandbox, using your own 2,500 plus unit portfolio to test software before you scale it. Walk us through a real example, like how did that actually play out with one of your portfolio companies?
Yeah, so I think one of the things that's hard, right, is that unit count moves all the time, right, and by multiples of that 2,500. And so I think that one of the things that's really valuable. So I'll give you a couple of examples. So there's a company in our portfolio, Soil Connect. They've built a data, their dirt and aggregates marketplace that also provides that pricing data. It's a huge industry. That data set doesn't exist unless somebody like a Soil Connect goes and actually builds that data set. And so I tried to use them for a project of mine that had a particularly hairy problem. And basically, what I was running into was that the way the product and the pricing worked, there was a lot of, I kind of had to like make a commitment to use the product without actually getting all of the information. And so what we figured out, and I kind of talked myself into, was, well, why wouldn't I just pay you a licensing fee? right? It takes your transactional revenue into more of an ARR, and then I get the information that I want, and then I can commit to the big ticket construction budget item. But it sort of helps both of us if we structure it differently, and so that was really helpful, I think, for both of us, and it was really sort of understanding that friction. I think another good example is we deploy lots of our software across properties. Myself and Old 300 use a AI analyst platform called Lenny, and then Old 300, because they have a lot more units, they're piloting PropUp, which is a management, maintenance, vacancy turnover, but really an OpTech tool for multifamily property operators. ResiDesk, which is AI communications with tenants through SMS, and then you've got sort of a variety of other products, right, that can be used at the right time or in the right place. So I think we use them all, and the learning is sort of in the trying to implement it. Like one of the other things we've learned over and over again is kind of depends on who your property manager is, and what the environment, the existing tech environment is, right? Maybe you're on RealPage and a piece of software doesn't yet have that data agreement, right? And you have to be on Yardi to use the product, or vice versa, right? So I think there's a lot of kind of just being willing to try it out, give it a test run, and figure out where the friction points are is sort of inherently helpful.
Okay. For the next question, I think I might have gotten a bit of flavor of it, but just to be clear, now PropTech has had a rough few years, a lot of overhyped products that never delivered. How do you tell the difference between a company solving a real problem and one that's just surfing the AI wave?
Yeah, it's a very good question. I think there's just maybe two layers to that answer. So I think the first one is founder. And so, what we generally say we're looking for is, a founder that's lived the pain of the problem that they're trying to solve and has both a deep understanding and a lot of conviction around solving that issue. And that means you have to be a relatively seasoned real estate professional in some, relative domain. And then you also have to have all the normal founder skills, right? And so I think that at least in my own experience, when you deviate from that formula, it's just a little bit harder. And so I think some of those prop tech headwinds are, maybe not, a founder that was a great venture founder but didn't totally understand the pain point they were solving in the industry, right? Or somebody that had trouble managing a team of engineers but really understood the problem. So I think that's sort of layer one. And then I think the second layer is that you're solving a problem if somebody will pay you to do it. And the easiest way to ascertain if somebody will pay you to do it is to make a proposition of you're already doing X. What if you pay me a fraction of that, whatever that math is, to do X for you, and make it better, right? And if you can't close that sale, that's a pretty good sign, right, that there's not product market fit yet, or there's something else that you're missing. And so we always say that you want about 500,000 to a million of revenue, right, that proves real traction. But more importantly, you have to have a toehold that's solving the pain point in the existing value chain, better, faster, cheaper, right? And if you can't do that, then like those are the table stakes. And then you get into the much more interesting kind of defensible positions, like are you through a piece of software that meets that first criteria and has a immediate ROI, are you building an impossible to replicate data set, right? Because I think that's where the real power is long term, but you got to get through the front door.
Now, I'm going to talk about something that you've said previously, and it's your advice for founders that taking venture capital is a one-way door. Once you take the money, you're locked in for a very specific set of expectations and timelines. As a, why are you warning people to be careful about working with you, and where does that come from?
Well, yeah, it's a good question. I mean, I think part of it is like it's a good filter if you're sitting in the allocator seat, right? That like you want somebody to have thought through all of the implications, right? And the implications are that every round you take, the expectations get higher, right? The margin for error gets thinner, and you get diluted, right? And so uh, some founders, when they set up their company, maybe they have structured the capital stack or the cap table in a way that is going to make it harder for them to earn money or raise money later. So I think that's sort of part of it, and I think that's where it comes from. Is right. There's a lot of really good businesses out there that shouldn't raise venture capital because they're not going to grow 40% month over month, right? And so then you have this situation where you've raised some VC capital, and I think it's true that the later stage you go, right, the more of a one-way door it is. Like you could raise a seed round, realize, hey, this is a good business, but it's a 50% year over year growth. It's steady Eddie, and I want to run it for 20 years, right? You have a shot to get your capital structure to match the strategy at that point, but you get to a C round and you're looking at a down round in your next financing, and it's a lot harder to untangle that. So I think it's more just sort of a desire for everybody to be thoughtful and well educated about what your set of options are, and that's one of the things we like about the seed stage, right? Is that you do have more flexibility, and you can if you encounter a challenge, right, you have that option.
Yeah. Now, how do you mentally shift between these two very different modes, like long-term asset management and on one side, and then the other side is early stage risk taking? How do you balance those? And
Yeah, it's a good question too. I think the way I look at it is that they're both just different flavors of risk taking. So I think that if you and really your job in either of these businesses is to be an active mitigator of risk, right? Like your core responsibility is taking risks. If you have an LP fund, it's you're taking risk on behalf of other people's capital and your own, which you've co-invested. If you have a real estate deal, same story, right? You're taking risk on behalf of your own and LP capital in order to generate a return, right? And so the day to day is really like, what are the big risks? How do you eliminate them, right? And reduce the magnitude of them if they do occur, right? Or reduce the frequency. And so I think that, like in a lot of ways, the finance side of both of these businesses are pretty similar. I also think that they're both highly relational businesses, right? So whether you got to pick up the phone and call the right investment sale broker that you've worked with a few times before, or you have a company that now needs a new CTO, who do you go to in your Rolodex? Like a lot of the sort of behind the scenes behavior, like I'm super rigorous about managing a CRM, right? I keep it constantly updated, kind of doesn't matter. And sometimes, there's no difference, right? And sometimes you think you're going into a real estate conversation and you're actually walking into a prop tech conversation or vice versa. So I think I don't know, we've thought about this a lot, right? But at the end of the day, I think having a foot in both of those worlds that is current, right, is generally valuable, even though the asset class itself is very different.
amazing. Um, I wanted to ask about Residesk, Lenny, and PropUp that you mentioned earlier as well. Like, what's the thread connecting those three, and what are they each solving that the old tools simply couldn't? And does it have to do with anything with adaptability within real estate, the friction towards or the inertia?
Yeah, I mean, I don't think there's a single prop tech company that's not true of. I think adoption is the hard part. And because what you often see with a sale, right, is you sell X, Y, or Z company and you get 10% of their portfolio, but so did nine other businesses. And then whichever one they like most, right, well, then, maybe they're down to two and you each get 50%, right? And so you have a real opportunity if you have a great product to have extraordinarily high net revenue retention. So I think that's one of the things that, when we're thinking about businesses, right, what does that process look like in addition to what does that initial sale or go-to-market strategy look like? And then I think they're very different businesses, right? But I think at the end of the day, they're both, or all three of those businesses are, like I said earlier, engaged in the creation of very hard, if not impossible, to replicate data sets, right? So Residesk is the easiest example. Like when those guys were starting that business, they were talking about how many insights you can get from this enormous customer segment that there was no data on, right? Apartment renters. Well, turns out the data set didn't exist, and so that became step one, right? How do you monetize that? With Lenny, it's a somewhat similar story, right? Where you have, sure, there's a lot of public data about real estate, but in Texas, as an example, we're a non-disclosure state, and so comps are harder to come by. And so what Lenny kind of allows you to do is to, through a better architecture than you would get in a world model that had multiple applications, is to take your proprietary data plus public data streams, right, and make the job of doing various sorts of analyses, reporting, acquisition, underwriting, what have you, right, better, faster, cheaper. It's something that you're still doing. And then prop up is the same story. Like there's, you know, most businesses or most buildings, right, will have a PMS, but there's no data set about how well cared for a unit was, or when the last time this piece, this maintenance was replaced. Or imagine you have 100,000 units in your portfolio, and you can reduce your turnover days from 25 days a unit to 10. I mean, that's tens, if not hundreds of millions of dollars in terminal value divided by any cap rate, right? If you can make these sort of small or incremental changes at scale, and you need software to do that, right? So I think that, and then again, in the process of doing that, making it better, faster, cheaper for others, right? You build a data set that, maybe in the future, when you transact on a building, right, you need that prop up data report where the basic unit of that data model is that individual unit, right? That doesn't exist now. And so that opens up a lot of opportunities and avenues, just like, was the case for Residesk or Lenny.
We talk a lot about data moats and the idea that once a startup owns the right proprietary data, competitors cannot catch up. Which company in your portfolio do you think is building the most defensible moat right now?
Yeah, and I don't know if I'd ever say that they can't catch up, but I think it changes the dynamics of that market a little bit. So I think the place where you get the most value is where you have a system that can, in a time sensitive way, right, keep data fresh. And then I think the other place is where there just isn't a data set, right? So I think a good example of this is Helix Intel. So Helix provides something called a predict and prevent engine, which allows you, as the owner or operator of a large facility, like say a public school or a hospital that has large building systems, that data, to the extent it exists at all, there's one legacy software company, maybe it's on pencil and paper. And so when, should you make this six-figure repair to your boiler, or should you replace it with a more energy efficient model? What does that do to your insurance costs, right? Those kinds of questions. And so once you figure that out, right, then the question is really, well, to have the best data set, you've got to get good distribution. And so what they've realized is that distributing through insurers and reinsurers gives you the most reach to the most number of properties and the most leverage on adoption. Plus, it opens up a whole other array of opportunities. And so I think that there's a lot of companies that are doing well with this, but I think that Helix in particular has not only figured out how to build that data set in a useful fashion, but I think they've also been very effective at figuring out the distribution.
Interesting. Now, I want to stop right here and I want to, it's very interesting the work that Stellifi is doing and how you're driving it, but what really makes it more interesting is the road you took to get here, because it doesn't start in finance, it doesn't start in real estate or in tech, and it starts in the open water. So, I mean, could you tell me a little bit about how your journey started? As far as I've learned that you were an instructor of a sailboat for a few years before, and I'm sure it must have been a roller coaster and lots of ups and downs. But I would love to hear a little bit about what really, consolidated your thinking and your philosophy and how, leadership as well.
Yeah, I mean, it is probably more anticlimactic than than you're expecting. But for me, it's like I figured out at a young age that I could be deeply and passionately interested in the things that I was interested in, and if I wasn't interested in them, I couldn't make myself be interested in them. And so I think, the sort of through line in my career is that whatever I was most passionate about is what I've done, at any given time. And I think there's a couple through lines you can read back through it, right? But the honest truth is that, I fell in love with sailing when I was a Boy Scout and went on a trip at the age of 15. And from that point until my late 20s, everything I did was to maximize, the time that I got to spend on a sailboat. And there were various ways to do that and various types of organizations to work for. And then in a similar fashion, right, that's sort of my sentiment about Stellifi and real estate, right? I've been thinking about it, more or less nonstop for about 10 years. And that doesn't show any signs of abating, right? And so you sort of follow the curiosity, and I think that sort of breeds some success. But what I really learned in sailing, right, was that I would do these programs, and every however long, right, a week, 6 months, whatever the duration was, you get a whole new group of people that were just an incredible smattering of humanity, right? Like I had vets coming back from Iraq and Afghanistan doing outward bound courses, you know, Tuck Business School students that were doing a pre-orientation trip, adjudicated youth, a bunch, women in their 50s who were making a career pivot, right? Like you think of it, right? And we, serve those populations. And I think that, at the end of it, it's sort of like the thing you learn over and over again is if you're in a small group of people trying to do big things in a dynamic environment, there's a lot of ways to fail, and there's not that many ways to succeed, right? And they're generally pretty consistent in terms of how you communicate with people, how you deal with problems, right? How you don't run away from problems. A lot of those skills are very, very relevant in early stage businesses.
I believe you walked away from law school as well to become a CEO of an ed tech startup. Is that correct?
Almost. I did end up finishing law school, but that's what brought me to Austin, Texas. Back to that point about being interested, I was a week maybe before I
Hmm.
realized, and I thought I wanted to be a lawyer for the majority of my life, right? So this is a big surprise. I just realized that it wasn't for me. It was, I didn't have relatives that worked in the legal profession. I hadn't, like a fool, I hadn't gone and been a paralegal somewhere. Right? When I showed up and I realized what the day to day looked like, I realized that I wasn't going to be one of the good lawyers, and so it was time to start looking for something else. And so I found this business, Famigo, that was at the time was hiring an intern, and it just raised a fair amount of venture capital. And so I ended up sort of pairing building this ed tech business, which I was the COO of, with my legal education. And so I would take courses that would reflect kind of the reality of that business. And I think in that way, law school became a very valuable education for me, in a way that it wouldn't have been, at least not to the same degree as if I didn't have this kind of real practical experiential application of it.
Yeah. Have you thought about law that for that long passionately until the moment that you decided to drop off, and then I believe you've done a degree in philosophy and some finance degrees as well. How do you feel like all these different disciplines, does, all of that background actually show up in the way that you're investing today?
Yeah, it's a good question. I mean, I think there's two pieces of it. So I think, at the end of the day, like a lot of what investors do, whether it's real estate or venture, is translate legal documents into Excel models and Excel models into legal documents. So I think that from a finance and legal background, right, those things fit very, very neatly. I think that where, one of the things that I feel like is a strength of mine is structuring transactions, and in somewhat non-obvious ways. And, inside my head, right, that feels a lot like philosophy, right? Like these, sort of shift your perspective, right? And you get a whole new perspective on a new problem and, or a hard problem you've been thinking about. And maybe now you have a new solution to it. So I think that that's been really helpful. And I think just the liberal arts in general, that's probably what I feel like I fall back on the most, right? Like finance skills or legal skills, they just become things you know how to do. But when I run into a hard problem, and law schools and finance certainly helped with this a little bit, but it's how do you what do you do when you don't know what to do? And I feel like I have a lot more of those situations than I have ones that are, totally straightforward. And I think that's sort of the liberal arts piece, right? Where it's, well, I don't know, let's get educated about it. Let's think about it from a ton of different perspectives. And let's make the best decision we can, right, in the time allotted. And I think that's, and think clearly about it, right? And I think that that's the liberal arts shining through, as well as the rest of it.
Okay. Um, I'm gonna I'm gonna move to a bit of a macro market, perspective now, and just to get your view on it. And I believe in your Jan 2026 newsletter, you flagged single-family rentals becoming highly political. What's going on there? And should institutional investors in residential real estate be paying any close attention to this matter or the politics behind it?
Yeah, I mean, it's what I think is happening is that our in the United States we don't have enough housing supply, which is this is a simple supply and demand dynamic, and we have some pretty good data that if you incentivize more development, I think Texas and the Sun Belt are great examples of this. If you incentivize more development, people will build, right? The trouble is they'll keep building until the incentive goes away to build, right? And then the last however many units in that cycle don't get absorbed, right, or have real financial distress. So I think we know how to create and incentivize more housing. What we don't know how to do is control that boom bust cycle, which causes a lot of pain and other knock on effects. And we don't know what our policy goals are either. And I think that's sort of the healthy part about the debate, right? So, you know, in this world that we live in, the one thing that both major political parties in the United States agree on is we should have a good housing stock that's affordable and achievable. So, but what I think is, unexamined a little bit is, well, is that the policy for 60, 70 years? The policy we had incentivized was to have the highest levels of home ownership as we could. Maybe I'm not a politician. Maybe that's the right policy. Maybe it's not. And also, what does the consumer want? And you see lots of data today about people choosing to rent, right? Or retirees that live on cruise ships, right? So you also kind of in the background of whatever policy decision you make have to understand that the market behavior is changing and real estate's still local, right? So if, city A has X, Y, and Z incentives and city B has ABC, well, if ABC incentives are better, B is going to get more housing, right? And it doesn't really matter what that macro policy is. So I think that's a big part of it. And then now we just have a lot more macro headwinds, right? Rates aren't ameliorating. We've had 2 years in a row now where at some point in the spring there's a geopolitical event, tariffs, and then the war in Iran that have really shaken the markets or caused mortgage rates to spike. And so I'm not entirely sure how all of this will ultimately end up shaking out, but I think that in general, you're sort of seeing a trend line towards incentivizing more product being delivered for housing, potentially financial assistance for buyers, right? So I think it's moving, right? But these are long-term problems, right? You
Yeah.
really fix a problem, you've got to get 10 million people out of a 2.9% mortgage,
Hmm.
right? And then they still are selling a house that was built in the 1960s and has $170,000 of deferred maintenance.
And we're talking about interest rates, mortgage rates, and then there's tight labor, compressed margins. The economics of running real estate right now are genuinely tough. Would you agree? And
Yeah.
is that a crisis for the operators you work with, or is it actually the best environment for the companies you back?
Very good question. I think it's a little bit of both. So I think that so if you think about the fund vintage that we're investing out of from 2022 at inception, you basically had no market in 2022. Now, there are things that are happening. There are certain market segments that are having a lot more deal flow activity. And so I think that in a lot of ways, when people weren't able to start or buy or sell new projects, they spent their time thinking about how to be more efficient when they could start doing so. I think now that they're doing so, right, you still have this drive for efficiency and this drive to cut margins, but now you also have like real problems that you have to solve with smaller teams. And so I think you're going to continue to see an acceleration of tech adoption, but I do think it's going to be a little while before things look anything like they did in the late 20 teens in terms of volume of development or deal transactions or valuations.
Interesting. Now, finally, I want to ask you for an advice for a prop tech founder who is pre-revenue and trying to get their first real estate operator to take a chance on their software. What's the most practical thing they can do to break through?
That's a very good question. I think we talked about this a little bit. You need to be crystal clear on the problem, right? So is the problem sufficiently well defined? And then if so, you have to find somebody who's willing to do just about anything to solve that problem because you need that opening, right? It can't just be a, sort of a normal cold call. And so you may have to sort of work through however many customers. And then I think the question at that point is, in the premise of the question, right? It's pre-revenue. So the question is, are you going to get more by getting this person's feedback when you solve their problem, or are you going to get more from this person by trying to validate that somebody will pay something for your product, right? And depending on the particulars, both of those could be pretty good answers. But that's how I would think about it. And I think that in general, this is sort of a core belief of ours at Stellifi. The adoption of these products happen in the lower middle market, right? You don't just go chase the logos day one because you have to meet SLA requirements. You have to have already hit some certain critical mass to prove that your product does what it says it's going to do. And so I think starting small and looking for people that are really banging their head against the wall for your problem is probably the first, or for your solution to their problem is probably the first step.
Amazing. Matt, this has been a really great conversation. And the one thing I want everyone watching to take away from this is the era of backing real estate technology without actually understanding real estate. I think that's old story now. And the operators who lean into AI now are going to be the ones still standing in 10 years. Matt and the team at Stellifi are right at the center of this shift. And Matt, thank you so much for being here. This was a great one. Really enjoyed talking to you and learning about your journey, and more so about how you and Stellifi think and operate.
Yeah, thanks a ton for having me. This is fun. I enjoyed it.